Ladies and gentlemen, welcome to the 8th Annual Conclave Corporate Bond Market Policy Pathways to Strengthen Market Stability and Depth. My name is Rishika and I'm going to be your host for this lovely morning. I thank each and every one of you for being here. It's time that we start the session, for which I would like to call upon our guests for the lighting of lamp. Starting with Mr. S. Ramann, Mr. Ananth Narayan ji, Mr. Pradeep Ramakrishnan, Ms. Nipa Sheth, Ms. Aditi Mittal, Mr. P.K. Malhotra, Mr. Bhushan Kedar, and Mr. Vasudev Mukherjee. All the guests, I request you to please come forward for the lighting of lamp. Please come together for a picture. Now it's time to start the 8th Annual Conclave Corporate Bond Market Policy Pathways to Strengthen Market Stability and Depth. Now, as you all know, that India's financial journey has undergone significant evolution over the past decade. Recent initiatives by SEBI has been instrumental in this evolution. The introduction of Bond Central, a centralized database portal launched in the February of 2025, significantly enhancing transparency and accessibility for all the investors. ASSOCHAM's 8th Annual Conclave on Corporate Bond Market serves as a crucial platform to explore these developments, discuss challenges, and chart the future trajectory of the corporate bond market, bringing together policymakers, industry leaders, investors, and experts for the dialogue, share best practices, and explore new opportunities. Now, with that, I would like to invite our guests on stage one by one. And as I invite them, I request you to please give them a huge round of applause, starting with Mr. S. Ramann, Chairperson, Pension Funds Regulatory and Development Authority. Please give him a huge round of applause. Thank you for joining us. Mr. Ananth Narayan ji, whole-time member, Securities and Exchange Board of India, SEBI. Thank you for joining us, sir. Mr. Pradeep Ramakrishnan, Executive Director, International Financial Services Center Authority. Ms. Nipa Sheth, Chairperson, ASSOCHAM National Council on Corporate Bond Market and Founder and Director, Trust Group. Round of applause. Ms. Aditi Mittal, Co-Chairperson, National Council on Corporate Bond Market, ASSOCHAM and Director, AK Group. Everybody, please put your hands together for her. Mr. P.K. Malhotra, Co-Chairperson, ASSOCHAM National Council for Corporate Bond Market and MD and CEO, IDBI Trusteeship Service Limited. Round of applause. Mr. Bhushan Kedar, Director of Funds and Fixed Income Research. Round of applause, CRISIL Research. And last but not the least, Mr. Vasudev Mukherjee, Assistant Secretary General, ASSOCHAM. Round of applause, everyone. These are our guests for the inaugural session. Thank you so much, all of you all, for joining us today. Now, with that, I'll now request for the bouquet presentation. Nipa ma'am, I request you to please felicitate S. Ramann sir. Thank you for joining us, sir. It's an honor to have you here. Next, I would request Ms. Aditi Mittal to please felicitate Mr. Ananth Narayan ji. Round of applause. Thank you, Narayan sir, for joining us today. Now I request Mr. P.K. Malhotra to please felicitate Mr. Pradeep Ramakrishnan. Thank you. Thank you so much. And now it's time for the opening address. The chairperson of National Council on Corporate Bond Market. The person who will be delivering the address is the founder and director of the Task Group, is a leading full-service financial services house with a leadership position in the Indian debt capital market. As the founder of the trust, she has been instrumental in shaping its growth and establishing it as a future market leader. She is also ranked among India's top 100 women in finance in 2020. It's an absolute honor to have her here. Ladies and gentlemen, please give a huge round of applause for Ms. Nipa, Sheth.
Good morning. A warm welcome to all of you. Shri S. Ramann, Chairperson, PFRDA. Shri Ananth Narayan ji, whole-time member, SEBI. Shri Pradeep Ramakrishnan ji, ED, International Finance Service Authority. Ms. Aditi Mittal, Co-Chairperson, National Council of Corporate Bond Market, ASSOCHAM and Director, AK Group. Mr. P.K. Malhotra, Co-Chairperson, ASSOCHAM, Council of Bond Market. Shri Basudev Mukherjee and Shri Bhushan Kedar ji. Distinguished guests, ladies and gentlemen, good morning and a warm welcome to all of you for the 8th conclave of corporate bond market under the theme Policy Pathways to Strengthen Market Stability and Depth. My special thanks to Ramann ji, Ananth Narayan ji and Pradeep ji to make it possible on a working day to be coming and addressing all of us on such an important occasion. The primary objective of ASSOCHAM is policy pathways to strengthen market stability and depth, is to create a platform for a meaningful dialogue between policymakers, regulators, industry leaders, investors, and issuers. The conclave aims to discuss practical solutions that can make the corporate market more stable, transparent, and inclusive. It will focus on ways to bring in more participants, improve governance and disclosure practices, and encourage the use of innovative instruments and digital platforms to increase liquidity. The discussion will also look at aligning India's bond market with global best practices so that it can play a stronger role in supporting sustainable economic growth. All of us are looking at 2047 as a Viksit Bharat, with infrastructure playing a very big role and bond market playing a very important role in this. We were having a very long discussion yesterday and we looked at number which is required to be around 143 lakh crore for infrastructure building. And I think bond market has to play a very important role in ensuring that dream of Viksit Bharat is there for all of us. Today, we have few issues. Some of them will be discussed during the discussion today. But I am pointing out certain issues and what kind of solutions we can look at. One is, of course, and biggest on the piece is low retail participation due to lack of awareness, complex processes, and low liquidity. We have vibrant equity market. However, I think the solution towards that has started. We promote financial literacy, simplify access through digital platforms, and create retail-friendly bond product. The issuance, where there is a high cost, especially for low-rated corporates. And there, I think we are probably looking at a solution of credit enhancement of mechanism where wider investment base to improve the pricing power of a corporate. A lot of new guidelines have come, and hopefully this should make possible for low-rated issuers to come to the market. The third issue being that, regulatory fragmentation with overlapping roles of SEBI, RBI, and stock exchanges. I think we also see the regulation and improved coordination amongst regulator for consistency and clarity. And we are seeing those messages over last 3-4 years, and we are actually making a deep impact on the bond market slowly and steadily. Absence of deep secondary market and lack of market makers, I think encouragement of market making, extending repo facilities to all securities and implementation of DVP3 settlement to enhance liquidity can go a long way for the bond market, secondary market volume to improve. We also see skewed participation and dominance of AAA rated paper and few large institutional players. Slowly and steadily, which has changed. Again, in last 3 years, we are seeing AA rated issuance more than 25%. And we are seeing that, with EBP, more participants are coming. Limited transparency, inefficient price discovery, mandate exchange-based platform, and strengthen the real-time data availability for trading and valuations. And I think you will see a big time. Inability to short government bonds reduces hedging and arbitrage opportunities, weakening liquidity in corporate bonds. And the solution is you allow short selling to government securities. Of course, it is allowed to the institutional players, but I think if everybody can take a view, it will have a huge impact on bond markets in terms of liquidity. In terms of global perspective, Indian equity markets are number 4 in the market today in the world, but when it comes to debt market, I think from any ratios, we are a little behind, though our incremental borrowing from bond market has become very, very effective. We will look at much vibrant secondary market as well. The foreign participation, hopefully with the JP Morgan Emerging Market Index, and I think in last 2 days, even Bloomberg taking the survey and the improved credit rating, we'll see more and more investor comings in the global markets from the bond as well. Positive long-term outlook of India's strong economic growth, young population, expanding digital infrastructure, and supportive regulations have given a solid foundation to grow a deeper, more vibrant corporate bond market, one that can match global standard in years ahead. In conclusion, I would like to emphasize that India's corporate bond market holds potential to become a key driver in achieving the vision of Viksit Bharat 47. A deeper, more liquid, inclusive bond market will not only support long-term infrastructure financing and reduce dependence on bank credit, but also strengthen India's journey to become developed, resilient, and global competitive economy. I'm hoping for a very enriching session during the day towards this objective. Thank you very much.
Thank you so much, Ms. Nipa. And now it's time for another address, ladies and gentlemen. Ms. Aditi Mittal, she is a chartered accountant and works as a director with AK Group. She has nearly had a decade of experience with the AK Group, building, managing, and engaging teams at AK. So please give her a huge round of applause. She's the Co-Chairperson, National Council on Corporate Bond Market, ASSOCHAM.
Good morning, ladies and gentlemen. It's truly an honor to be here with you at ASSOCHAM's 8th Annual Conclave on the Corporate Bond Market. I would like to thank the organizers for bringing all of us together to discuss the evolving landscape of India's $2.78 trillion debt market. In particularly, corporate bond contributes more than 22% of this size, which accounts for approximately US dollars 627 billion as per financial year 2024-25. And what is to be noted is this is 13.42%, higher than financial year 23-24. So yes, we all are in the right markets, which is continuously growing. As many of you know, corporate bonds are an essential component of a capital market. They help companies raise funds beyond the traditional bank loans and offer investors, especially who are looking for fixed income products, an alternative to mutual funds and bank deposits. According to NSDL, 5,700 companies tapped corporate bond market in calendar year 2024. What is to be noted is already 3,237 corporates have issued year to date in calendar year 2025. This marks an underscoring of a steady, sustained, and a stable pipeline. In financial year 24-25, traded volume in corporate bonds reached rupees 17.1 lakh crore, which is approximately US dollars 200 billion. And it is right to say, as Ms. Nipa also mentioned in her speech, in equities, we are the third largest country. In debt, we are still to be there. But in spite of that, these are the volumes that we are talking about, so we can look at the growth trajectory which a corporate bond market is going to trace. This volume of rupees 17.1 lakh crores is 24.5% higher than nearly as compared to the last year, which is as compared to the years which has been flat in the consecutive years for last 6-7 years. The number of trades in financial year 24-25 stood at 11.9 lakh trades, indicating a broader market activity even though the depth is still uneven. In the first 4 months of financial year 2025-26, the traded volume has already touched 8.47 lakh crore, which if you annualize, means there is a growth of 48.5% in the volume. While what is more interesting is the number of trades. The number of trades is as of today stands 6.9 lakh. 6.9 lakh trades only for this financial year, which stand, sorry, my data is a little wrong. With the trade counts of 6.9 lakhs, which we annualize will be about 20.69 lakhs trades for this financial year, 25-26, which means there will be a 74% growth in the number of trades as compared to the last financial year. This signals a sharp acceleration in participation, especially from the non-conventional investors. What has made this happen? Technology, regulation, support, and the need for portfolio diversification. One of the recent developments worth highlighting is the emergence of online bond platform providers, which we call as OBPPs. Now there are more than 40 OBPs which are registered with SEBI and exchanges, which are proving to be a pivotal moment in the evolution of India debt capital markets. For years, bond markets are largely the domain of institutional players. High ticket size, lack of innovation, and limited access kept the non-institutional investors at bay. But these platforms have changed the game. These platforms have brought the transparency to the pricing, rating, and issuer information, lowered the entry barriers through small ticket sizes, enabled seamless digital onboarding and KYC, curated bonds across the issuer, tenures, and credit profiles. This has enabled many issuers who earlier could not tap the corporate bond market, now today are easily finding investors if they issue bonds, and also empowers investors with choice and control. Needless to say, with SEBI's thoughtful regulatory framework of OBPs, we are seeing a balance of innovation and investor protection. Another major shift we are witnessing in the rise of technology in the bond market. Whether it's through the use of blockchain for faster settlement or AI for better credit assessment and risk profiling, technology has changed the game the way they did it for every other sector, and now the corporate bond market is not going to be far behind. Digital bond platforms are also simplifying how bonds are issued, traded, and monitored. This is especially important as we try to bring more participants in the market, making it easier and safer for investors, both big and small, to engage confidently and to win their trust. These advancements not only reduces costs and inefficiencies, but also increases transparency, something that builds much needed trust in the market. Let me now turn to the area that I believe holds enormous untapped potential, which is the non-conventional, non-institutional investors. Historically, corporate bonds have been the domain of mutual funds, insurance companies, and large investors, but no more so. If we need the money to make our infrastructure, if we need a Viksit Bharat, we need all of us to participate in the bond market. But that's starting to change. We are seeing encouraging signs, the launch of bond ETFs, user-friendly investment platforms, government and regulator-supported awareness campaigns. Yes, education is the way to the investment. These efforts are being to lower the entry barriers for non-conventional, non-institutional retail investors. However, greater financial literacy is the key. Many retail investors are still unfamiliar with how bond works, their risk, their returns, and how they fit into a broader diversified portfolio. We must continue to educate and equip them with the right tools so they can participate confidently and responsibly. Of course, challenges remain. We still need to deepen the market liquidity, simplify issuance processes, and enhance the credibility and consistency of our market. Regulatory framework must continue evolving in the support of innovation while protecting the investor interest. At the same time, we need to invest in infrastructure, especially as we adopt technology like blockchain and AI. Corporate bond distribution network also needs a clear and a uniform regulatory framework, similar to an authorized person in equities and AMFI registration numbers in mutual funds, to enforce fit and proper criteria and reduce the scope of mis-selling. All of this will help to build a more robust, transparent, investor-friendly bond market. In closing, I would like to say this. The corporate bond market is not just a financial segment. It's a growth engine. It can power business expansions, channel household savings into productive use towards Viksit Bharat, and help India build more inclusive and resilient financial system. With the combined efforts of the regulators, issuers, investors, and technology, I believe we can unlock the full potential of this market. Thank you once again, and have a very good day.
Thank you. Thank you so much, Ms. Mittal. Ladies and gentlemen, it's now time that we release the ASSOCHAM CRISIL Knowledge Report for the year. I request all our guests get ready for the release of the knowledge report. To everybody in the audience, I think there's a QR code right there. You can scan it and you can have the access to the knowledge report as well. Yes, ladies and gentlemen, please give a huge round of applause. This is the release of ASSOCHAM CRISIL Knowledge Report. Thank you so much. Thank you to all our guests. Thank you so much. Ladies and gentlemen, once again, you can have the access to the knowledge report. The QR code is right there. Please scan it, and I think we'll also mail you. And if you want, you can connect with our team for the knowledge report. Now, moving on to our next speaker. He has a work experience of over 22 years in the capital markets and analytics. He leads the capital market research practice in CRISIL Intelligence. He joined CRISIL in 2006 and has been leading product verticals, including fixed income and structured products valuations, mutual fund research, qualitative assessments for asset managers, indices, and new products. It's an absolute honor to have him here. Ladies and gentlemen, please give a huge round of applause for Mr. Bhushan Kedar, Director, Funds and Fixed Income Research, CRISIL Research.
Hi, good morning, everyone. Respected dignitaries and attendees, I would like to thank ASSOCHAM for partnering with CRISIL to release the report. Ms. Aditi has already spoken about some of the key statistics that we have seen in the bond market, how bond market has really grown. Probably I'll speak about some of the trends that we have highlighted, and the report Bonding the Gap basically talks about how we see the landscape of Indian debt market. Within that, the role corporate bond market is playing in terms of size, shape, concentration across issue profiles, maturity profiles, in terms of liquidity, how it is shaping up, regulatory initiatives that are shaping the retail market, the trends that we are seeing on the private credit. I think that is going to play a very important role as we move along. And also in terms of next steps that we see would be critical to develop the bond markets. And I'll just talk about some of the key messages Firstly, markets are growing sharply. We have seen 12 to 14% CAGR over last 5-6 years. The sovereign markets have grown sharply after the COVID. Of course, the fiscal deficit actually led to larger amount of both GSEC SDL issuances. So there was a bit of crowding out for corporate bond markets, but now they are coming back in action, and we've seen one of the best possible years last year, and this year too will probably clock a great volume on the corporate bond side. The other important aspect that we are also seeing is the non-AA segment is now between 16 to 22%, which is continuously there for about last 2 to 3 years, which is a good sign. One of the elements which is concentration in terms of issuer profile, financial institutions, NBFCs, HFCs continue to play a dominant role. The private corporate, which ideally should be tapping this market, is about 25%. I think that number has to grow significantly up. That is one room for, I would say, growth that we should certainly look forward to. Besides that, when we'll compare Indian markets with global markets in terms of penetration, and when we look at penetration, we are looking at the bond outstanding to GDP. We are in the range of 16 to 22%. Some of the markets which have been able to gain traction there certainly is China, South Korea, with north of 35 to 40% in terms of penetration. In fact, South Korea probably started their journey also late like us, but some of the policy initiatives has helped them to move to that. That's one, certainly a key takeaway. US market has been, in that sense, has depth and breadth. So we should certainly look at the initiatives which are there in some of the newly developed markets, so to say. Besides that, I think the liquidity, and Ms. Aditi did speak about volumes, but globally too, we see liquidity in the outright space is not really high. The numbers range from, on an average daily trading volume to outstanding ranges from about 15 basis point to 30, 40 basis point, and we are somewhere there. But what is really necessary for liquidity in the market is derivatives, and repo is one of the key elements. The good part is regulators allowed repo on the bond markets. In India, the platform has been set up, and that is also doing quite well. And growth of that will also help getting a temporary liquidity for the asset managers in that sense. So that's an important initiative. Going forward, I think there are 2 or 3 areas. OBPP has given a good boost to retail investment in terms of getting a very transparent and organized market, so to say. But certainly to get retail investors to come and invest in bonds, awareness is, I think, is a key issue. Probably that is one area that really needs to be worked upon. Besides that, I think taxation has really helped. In the history also, we have seen tax swaps have helped people coming to investing in bonds. So anything on the taxation side will certainly help. If I was to look at mutual fund and debt mutual funds, of course, parity when it comes to equity, treatment to equity and debt, I think if that is something which will be brought in, that could certainly go a long way in boosting the investment in debt mutual funds and thus the bond market. And lastly, the AIFs, which is a space which is picking up significantly. There too, there are broad, sectors are, issuers are coming to that market, raising funds and alternate investment funds through family offices, large institutional, not just domestic, but the global investors are coming in. I think taxation is one piece there, certainly could help the boost market favorable tax regime. So I think these are some of the initiatives that we do believe can really help shape the bond markets and the kind of growth trajectory we are looking at. So once again, happy reading the book, and good day to everyone. Thank you.
Thank you so much, sir, for shedding light on the knowledge report that we just released. Our next speaker has over 3 decades of experience in various capacities, including in an individual and corporate marketing, LIC Housing Finance Limited, legal and corporate strategy and investment functions of Life Insurance Corporation of India. He has more than 12 years of experience in managing diverse investment functions such as debt, equity, treasury, and ULIP fund management. Please give a huge round of applause for the Co-Chairperson, ASSOCHAM National Council for Corporate Bond Market and MD and CEO, IDBI Trusteeship Services Limited, Mr. P.K. Malhotra.
Good morning, ladies and gentlemen. It is indeed a privilege to join you all at the 8th Annual Conclave on the corporate bond market here in Mumbai. This year's theme, Policy Pathways to Strengthen Market Stability and Depth, captures the very essence of what India capital market needs at this critical stage of our exponential growth journey. Yesterday, few of us, just Nipa said, present here, were attended that NAFED Infrastructure Conclave 25, where significant policy pathways to strengthen the economy was discussed, especially in the area of credit enhancement and sector innovation, which will help in development of corporate bond market. The partial credit enhancement framework, which was announced in Union Budget 25-26, and the new credit enhancement guidelines released by RBI in August are a game changer. It has expanded the partial credit enhancement to include scheduled commercial bank, all India financial institution, NBFCs, housing finance companies. It has further increased the level of enhancement provided by single partial credit enhancement to up to 50% of issue size. It has optimized capital requirement on this partial credit enhancement. I feel it will be a game changer in times to come. And secondly, I feel the timing of this conference is good because from Monday, 22nd September, this GST2, which simplifies the tax structure to 2 slabs, 5% for essentials and 18% for standard items. Now we can expect the private sector to regain renewed confidence. Capacity building will follow. Business are likely to begin investing more aggressively. So more capex, more bond issuance may be there as a result to strengthen the market. Hence, the robust corporate bond market can strengthen the 3 pillars of GDP, consumption, investment, and government spending. It was an eye-opener yesterday. They told that in India infrastructure need till year 2047 will need roughly 770 million rupees across transportation, energy, urban infrastructure. To fulfill such a challenge, the developed bond market can play a transformational role by fueling the private investment, making credit more accessible. Now we can feel that diversification of credit source is happening to fulfill such a huge requirement. Earlier, the dependency was just on bank credit. Now, if you see, other alternate sources like even AIFs, they have grown exponentially. Now roughly 5.7 lakh crore, and with the cumulative commitment of around 14.2 lakhs, RFs, InvITs, they have also able to mobilize a significant amount of money. The corporate bonds, if you see even in the first quarter, they, as per the prime data, their issuance is around 3.43 lakhs, showing a growth of 66.75 growth. And the bank credit have grown just 9.9% in Q1. And even last year, as per prime data, it is around 11 lakh crore issuance have happened. Now even other municipal bond, green bonds, all are happening. So today only this CRISIL report, if you see, Indian bond market is valued around maybe 58 lakh crore, representing around 20% of GDP. And for the advanced countries, is significantly high, maybe touching even more than 50%. This corporate bond is critical because it provides specially a long-term financing, which is beyond bank credit, and our huge requirement is there for infrastructure needs. Now coming to the theme of this conference, for deepening market for corporate bonds, what policy pathways are needed? According to me, first, as Aditi was also putting, we have to encourage retailer and especially high net investors participating through this regulated digital bond platforms and debt ETFs. Especially this Bond Central, which have been launched recently in February 25. I feel each one of you should try to explore that. It is definitely provides a lot of transparency, and it is designed to offer comprehensive and dynamic data and provide all relevant documents which are needed, like information memorandum, term sheet, and a lot of good comparison. If you explore, they show on this GSEC and other things. Other platforms are also there. The bond info is there, maintained by NSDA. And secondly, our target should be to double the market size of corporate bond as in the developed country, to especially from 20% of GDP to 40% of GDP by incentivizing more public issuance. Now more partial credit provider institutions should come forward to support the low-rated corporate bonds, and there should be, I feel, more public placement instead of private placement, which is happening. Secondly, recently Indian sovereign rating was upgraded from BBB minus to BBB. I feel it will further position India's corporate bond as a preferred choice for international investors through GIFT City, and already the inclusion of Indian bond market into major global indices like Bloomberg and JP Morgan has already enhanced visibility and liquidity and investor participation. And now coming to the other topic of today's, for market stability, I feel the policy priorities should include further strengthening of credit rating framework and a standardization of documentation and processes needed for corporate bond. In this regard, I thank SEBI because in their 18th June current year board meeting, in principle, SEBI has agreed for standardization of document for DT. I believe by moving towards standardized templates and process, we can simplify the market access, reduce legal ambiguity, and promote wider participation across the investor spectrum. Consider how the standardization of UPI has transformed the India's payment ecosystem. Secondly, now we have a bond repo market platform, AMC Repo, which was launched in July 23 for the debt mutual fund. It is already ensuring orderly market functioning. Further, third is we should have improved risk management through derivatives like credit default swaps. Recently, last week only, India was ranked in Global Innovation Index 38, which is a huge success for the country. It reflects our reform impact and confidence. Corporate bond market is poised for the similar leap, deepened by regulation and wide participation. With digitization and wider participation, India can establish itself not only a regional leader, but a global benchmark in bond market. And in this, for market stability, one of the key elements is we have to enhance bankruptcy resolution, investor protection, and strengthen enforcement mechanism. percentage of recovery has to increase significantly above 50%. If we have to resolve the dispute with fairness, timeliness of the enforcement is as important as prevention. Here, our role as a trustee is critical for timely enforcement, since we are legal owners or the charge holders in secured lending. Every covenant we monitor, every disclosures we validate. Enforcement is done effectively. Here also I want to congratulate SEBI for codifying the rights of DT. Ladies and gentlemen, let me close with one thought. Markets are built not just on platform or policies, they are also built on trust. Trust of the issuers that they can raise fund effectively, trust of the investors that their rights are protected, trust in the institution that safeguard transparencies and accounting. Let we strengthen the foundation of trust. India's corporate bond market will not only achieve stability and depth, but will also stand as a benchmark for the world. Thank you for this opportunity to share our vision. I look forward for this inside discussion I had today.
Thank you. Thank you so much, sir. And ladies and gentlemen, it's time for a special address now. Our next guest has a distinguished career of over 27 years. He's headed the Compliance and Monitoring Division, focusing on corporate governance, long listing matters, BRSR, and the Forensic Accounting Cell. Currently, he leads the Department of Capital Markets, overseeing corporate finance, market infrastructure institutions, sustainable finance, investment funds, new products and services, and supervision of the intermediaries. He is the Executive Director of International Financial Services Centers Authority. Please give a huge round of applause for Mr. Pradeep Ramakrishnan.
Morning, everyone. And it's an honor to share the stage with such distinguished guests, particularly two gentlemen with whom I have had the pleasure of working earlier at SEBI. And I was also pleasantly surprised with the numbers which Aditi was doling out as far as the OBPs were concerned, which, as I remember when we were trying to bring that reform. Because any reform initially is always disruptive, right? And you'll have to sort of accept how disruptive it can be and what that such disruption can actually cause and try to change things. And that's how I'm pleasantly surprised. We've got 40 online bond platforms. I think that is something which is good, because whenever you take any bond market, people always talk about the report of any bond market always says development of the bond market, right? So there is a need, and I'm happy to note that the shallowness of the bond market in India has been to some extent broken by the fact that retail participation has actually been improved because of online bond platforms. And that is it's a good thing, because it was always looked upon as a tax-saving instrument, and once the government stopped that, I think retail investment interest in the bond market completely vanished. So I have now moved on to the IFSCA, the International Financial Services Centers Authority, and I've been given 4 minutes to speak. So anyway, so I'll just say, as far as IFSCA is concerned, it has been set up with a threefold objective. One is to onshore the offshore. The second one is to be a hub for global capital flows and finance flows. That is where the bond markets come in. And the third one is to be a hub for innovation. Now, as far as the bond markets are concerned, I'm quite happy to tell you that the bond market has quite taken off at the GIFT City. It has become the preferred destination for Indian companies, the Indian corporate, for ECBs, for international borrowings. Now, we recognize borrowings in 15 different international currencies, with the dollar, euro, and the yen being the most popular currencies of borrowing. And of course, the dollar actually has the lion's share of, in which the money is getting borrowed. And as far as statistics are concerned, because the proof of the pudding is in the eating, as my chairperson always says, we have got almost 150, 160 issues of bonds being made and almost $70 billion being raised. And those numbers will look very different when you convert them into Indian currency. And that's been quite good as far as that is concerned. One thing which is setting apart the IFSC is the fact that we wanted to become a hub for climate and sustainable finance. Now, the issue with climate and sustainable finance is what is green for you is not green for me. That is how the world has sort of approached this whole ESG and sustainability related issues. But what we have tried to do is that instead of reinventing the wheel by creating a taxonomy of our own, we try to imbibe all the international taxonomies, and we have accepted a few international taxonomies that are quite credible for both the issuers as well as the investors. And so we have accepted the ASEAN taxonomy, the ESMA taxonomy, and ICMA and all that. And in fact, SEBI's taxonomy on green bonds actually has its moorings in the ICMA taxonomy. So, and India's sovereign green bond issuance also, takes the ICMA taxonomy into account. So, while there are different taxonomies, some are principle-based, some are principle plus rule-based, and some are quantitative and some are qualitative, some actually marry both. So, this has actually helped us to have almost 50 to 60 issues of green, social, sustainable, and sustainability-linked bonds in the IFSC, which is quite remarkable. And we have raised almost $16 billion, $17 billion of money has been raised by corporate in the sustainable finance space. Now, whenever you talk about any market, there needs to be an ecosystem. Now, apart from the regulator. So what we have tried to create in the IFSC is to have separate stock exchanges. We have 2 separate stock exchanges of our own where these bonds are raised. Of course, trading has not started to happen because that is where liquidity is where actually then you're going to get more players. So that is something which is probably starting. One other issue also is the fact that since these are bonds which are also raised by international customers, some of the preferred depositories are international. The ICSDs are where these bonds are housed. But of late, the local depository has also picked up steam with almost the last 30 odd issues of bonds happening on the local depository. So we have got a good credit rating ecosystem. We have got 2 homegrown credit rating agencies which have taken, licenses with us. We have trustees. Now, one small thing before I go, as far as credit ratings are concerned, of course, we recently have been upgraded by international rating agencies. Now, there was also quite a lot of talk about the whole concept of this international rating itself about of countries. So, I would like to give you a small snippet of information. So, the first rating license was taken by Carriage Global in the IFSC. Recently, S&P Ratings has also taken. Now, a publication that came out was on sovereign ratings of 39 countries, India also being one of them. And one of the things which also needs to come from an international finance center is the value it can add to the international ecosystem. Because what has happened is, after the release of this report, there have been international rating agencies have actually revisited the ratings of many countries. Now, all along we've been used to a different set of ratings. So, one of the things which has been told to the IFSC is to move the needle. And I hope we are trying to do some job as far as that is concerned. So, before I go, I would like to request issuers, arrangers, and merchant bankers and other parties to explore the GIFT City. Of course, this is something which has been created by the government for you. And we will be very happy to hear you. And we can always have a dialogue on your fundraising, what you want to do. And one of the things which we have also tried to do as far as the regulation is concerned is that we have tried to keep the regulations as a fit for purpose. I wouldn't want to use the word light touch because that's a little derisive, because it looks as if the investors are not taken into account, right? But we have got a robust investor protection system also. And we have taken a lot of inspiration from SEBI on investor protection and other related matters. So welcome to IFSCA and welcome to GIFT City. I hope to see you, some of you there. And even if you are not available, we can always have calls and video calls and we can take it forward. So I wish the conference the very best.
Thank you so much, sir. It's been a pleasure to have you here. Now, ladies and gentlemen, it's time for the keynote speaker. As you all know, he is a whole-time member of Securities and Exchange Board of India, SEBI, looking after Market Regulation Department, MRD, Alternative Investment Fund and Foreign Portfolio Investors Department, AFD. He's also served on several boards, including as Independent Director on SBI Capital Markets, Additional Director appointed by RBI on Yes Bank Limited, Public Interest Director appointed by SEBI on NSE Clearing Limited. It's an honor to have him here. Please give a huge round of applause for the whole-time member, Securities Exchange Board of India, SEBI, Mr. Ananth Narayan ji.
Thank you very much. Mr. Ramann sir, Pradeep, Nipa, other dignitaries on the dais. It's really a privilege to be here today at ASSOCHAM to speak on a subject that is both timely and crucial for our economic future, the policy pathways to strengthen market stability and depth of India's corporate bond market. Now, before I start my boring speech, I have a few preliminary comments to make. One is, I'm a very poor substitute for my fellow whole-time member, Amarjeet Singh, who actually looks after debt markets in SEBI. He's unable to come here, so I'm here in his place and in the place of the Executive Director, Maninder Cheema. The second thing is, I do have a passion for bond markets. I used to be a fixed income trader myself for many years. 25 years ago, when I was pushed to join a committee, the topic of that committee was how to deepen corporate bond markets in India. Some things never change. Even today, I'm sure fresh people coming into the market are discussing the same topic all over again. It's not that nothing has happened. In fact, a lot has happened. But the reality is there's a lot more to go. What I thought I will do is tell you SEBI's perspective on how we are looking at corporate bond markets and other asset classes and why we are thinking what we are thinking. I just want to make one preliminary point as well. The distinguished fellow regulators here, Ramann sir, Pradeep, and myself, we all have one common heritage, which is SEBI. We all had some stint with SEBI at some stage or the other. So let me give you the backdrop as to how SEBI is looking at corporate bond markets. And I'm going to start, strangely enough, with the equity markets. If you look at fiscal year FY25, the total amount of demand for equity paper coming from domestic investors via mutual funds, via pension funds, via insurance companies, and directly was a staggering 8.8 lakh crores. This is data which has come from the depositories directly. This is across secondary and primary markets. That's $100 billion equivalent of demand for equity paper. The total supply that came in was about 4.6 lakh crores. You could argue, therefore, that the supply of fresh paper, which includes IPOs, FPOs, rights issues, QIPs, and so on and so forth, is much less compared to the demand for paper. What that tells you is that over the last few years, and these numbers are staggering in the way they've grown over the last few years, you all know that. Today we have more than 13 crore unique individuals who are participating in our equity markets. So the appetite for risk with the domestic investor has grown dramatically. Now, given this backdrop, and given this mismatch, you could argue, between demand and supply for paper, there's a lot of takeaways for all of us as a collective ecosystem. From an investor perspective, all of us know that asset allocation is the most crucial part of financial planning and investments. You can't have all your eggs in one basket, which means besides equity, you also need to have fixed income, you also need to have corporate bonds, you need InvITs, REITs, you need commodities, you need foreign currencies, you need the whole gamut. So purely from an investor perspective, it is imperative that all of us collectively, including the regulators, look to develop asset classes so that investors have a rational choice ahead of them. From an issuer perspective as well, with so much of risk appetite now developing in the ecosystem, you need to have different kinds of instruments being launched as well. We definitely need corporate bonds because that's a great way to disintermediate the financial ecosystem get money directly, particularly for areas such as for infrastructure. Similarly, InvITs and REITs, which again is very close to our heart, along with munis, great way to unlock capital from existing builders, sponsors, asset holders, and therefore further the cause of capital formation. So both from an issuer perspective and from an investor perspective, which means collectively for capital formation, make no mistake, we need more asset classes. You've heard the chairman of SEBI speak recently about the need to develop commodity markets. The same theme works as far as corporate bonds, InvITs and REITs is concerned as well. This is an imperative, and we have to work on this together. Now, where do we stand today? The progress so far is not trivial. A lot of good things have happened. So the outstanding corporate bonds has risen from about 17.5 lakh crores as of March 2014 to about 53.6 lakh crores as of March 2025. That's a compounded annual growth rate of over 12%. So we have seen very reasonable progress. As you know, and many of the speakers mentioned, the issuance that we saw in FY25 was over 10 lakh crores by itself. But there is still obviously a lot to be done. Now, clearly, SEBI, along with all of you, the entire ecosystem, we have tried to do a lot over the years, and some of this progress has been, again, chronicled by people like Nipa, Aditi, etc., and Bhushan. But I'll just quickly summarize some of the things that we've tried to do. Most recently, and again, this is not directly corporate bonds, the SEBI board has just approved a proposal for mutual funds to treat REITs as a part of the equity asset class. This should give a fillip to this important asset class. You've heard about the Bond Central, where all of us collectively, we've tried to create this platform which has all the data required around corporate bonds. I think there's a lot of work to be done in improving the quality of that bond platform, Bond Central, but again, it's a great starting point to ensure the awareness about bonds increases. Many speakers have spoken about the online bond platform providers, the OBPPs. I think it's a great initiative to try and democratize corporate bonds, make it available to more retail people. Of course, it's an ongoing journey. We have to balance ease of doing investments with investor protection. I'm sure there are lots of relevant feedback that can come to us as to how to improve this, and we will take that on board. We've tried to lower entry barriers, including going down the path of reducing the ticket size to 10,000 rupees, which is a huge move to try and get more retail participation. We've provided liquidity window facilities, allowing for issuers to buy back bonds. We've talked about the ARCL, the Limited Purpose Clearing Corporation for repos, which now has clocked over 55,000 crores of volume in the month of August. So it's clearly come a long way. And again, we are in discussion with other regulators to make it even deeper. We also have the CDMDF, which is the backstop facility to buy corporate bonds if, God forbid, there's ever an event which requires some kind of a lender of last resort kind of activity. As Mr. Malhotra mentioned separately, the government too has stepped in. In this current year's budget, 25-26, NABFID was tasked with launching a partial credit enhancement facility for infrastructure corporate bonds, enabling even below AA companies to tap bond markets. Now, this is another feature that we clearly have to work on. As all of you know, you're all experts in the corporate bonds, 90 to 95% of our bonds are rated extremely high. It's A or above, right? If you see the same structure in the US, and maybe US is a bad comparison, not a fair comparison, but you have about 40% of the bonds which are either BBB or below investment grade. Now, when you have so much of interest in Indian investors for mid-cap, small-caps, micro-cap equity stocks, the need for us to expand this credit spectrum for corporate bonds also is, I think, only underlined even further. Coming back to the government, the Urban Challenge Fund, with an outlay of 1 lakh crore, should finance up to 25% of urban projects, but with a stipulation that at least 50% of costs be met through bonds, loans, or PPPs. Let me turn now to the municipal bond opportunity. Municipal bonds are especially vital by 2047, most estimates say that more than 50% of Indians will live in cities. Yet from 2017 till date, we have just had 16 issuances raising around 3,100 crores, a mere 0.02% of GDP. Clearly, we have a lot more to do. SEBI is pushing this hard. My fellow whole-time member Amarjeet is evangelical about municipal bonds, but clearly a lot of collective work has to happen here. Let me close with a few personal thoughts on the ideas for the future. Again, some of the speakers have spoken about this. We perhaps need to popularize trading in corporate bonds. Now, this might sound strange coming from a regulator saying we should trade more. But I do think we possibly need to inculcate that culture a lot more. Today, while we celebrate, and I think Aditi mentioned that the volumes in secondary markets have gone up dramatically, but we trade as much in a single day in equities in secondary markets as much as we trade in a month in corporate bonds. So clearly there is room for us to improve a lot more. Maybe we should explore ways where we allow corporate bond trades to happen with the same kind of efficiency and effectiveness that happens in equity markets. Now here I would strongly suggest, please come up with your suggestions on how we can make this happen. Let's be a little bold in thinking through how this could happen. Could we have settlement systems very similar to what happens in equities? Could we have the trading infrastructure, including things like maybe allowing shorting, maybe allowing lending and borrowing, long-term bond forwards? I'm not saying this will happen, but I'm saying this debate can start. Don't start printing from tomorrow saying SEBI is considering all this. This is a personal view. All I'm saying is it's time that we started thinking about how do we deepen the actual trading in corporate bond markets. Similarly, I think another idea which might take off, and we are hopeful it will take off soon, is building corporate bond indices to encourage derivative trading in them. We've talked about CDSS, but we are now working with other regulators to see how do we actually popularize trading in corporate bond indices, which might lead to more awareness around that on the particular markets. I'm sure this gathering will have many more ideas for furthering the cause of corporate bonds, InvITs and REITs, and credit markets in general. Many of these proposals may not pertain directly to SEBI, but I would encourage ASSOCHAM to share your collective thoughts with us. Given the constructive dialogue that is ongoing between different regulators and policy makers, SEBI would be happy to lend support to constructive ideas that address our common objectives of ensuring sustained capital formation. Friends, the message is simple. Indian capital markets have made solid progress, but we have miles to go. If we want markets that are stable, deep, and resilient, we must build a corporate bond market that truly complements our equity market. We must also nurture and spread awareness about alternative asset classes, InvITs, REITs, munis, and commodities, and build a balanced financing ecosystem worthy of India's growth ambitions. We in SEBI look forward to helping co-create this future collectively with you and all other stakeholders and ensure sustained capital formation. Thank you so much.
Thank you. Thank you so much, sir, for sharing such meaningful insights. I am sure everybody in the audience was taking notes while you were speaking. I remember hosting the same conference last year, and one of our speakers asked a question, which was, how many of you all have invested in corporate bonds? Can you tell me how many of you all have invested in corporate bonds? Please raise your hand. Great. Still fewer in number, but believe me, last year we still had less numbers. And I was reading today morning only that the investment in corporate bonds have risen significantly. So I am sure, sir, with your guidance, it will continue to rise. Thank you once again. Can we have a round of applause for him? Now it's time for our another keynote speaker. Again, it's an honor to have him here. He served as an officer of the Indian Audit and Accounts Service from the 1991 batch. Prior to joining the PFRDA, he served as the Deputy Comptroller and Auditor General and Chief Technology Officer in the Office of Comptroller and Auditor General of India. He's also served as Chief General Manager and then as ED at the Securities Exchange Board of India, SEBI. Ladies and gentlemen, please welcome the Chairperson, Pension Fund Regulatory and Development Authority, Mr. S. Ramann. Round of applause, please.
A very good morning to all of you. We've heard some outstanding speeches today and some very educative content also. So it's wonderful that ASSOCHAM has put this conference together and brought before you really a great set of speakers. I myself have learned a lot today. But it's an honor to stand before you and talk about this segment. No doubt, I'm not going to go into too many of the numbers, but I think a couple of numbers stand out very starkly, and therefore many of us would end up repeating a few important statistics. The US has corporate bonds outstanding of 40% of GDP. India is at 18%. South Korea is somewhere in the region of 80%, and China at 36%. Yesterday in the NABFID conference, as we had Nipa also there yesterday, and Mr. Malhotra, I think, was talking about it. It was heartening to hear Mr. K.V. Kamath tell us that in 2008-9, when China's GDP was roughly a similar number as what India is today, the development of the bond market and other markets, including the equity market in China, was quite similar to that what we have in India today. So I'm just, putting that in perspective, that with the growth of the economy, we would naturally see the growth of all these attendant markets, because that's really the vehicles for growth of the economy. We are looking at a trajectory which is quite extraordinary. Aditi brought out some great figures. 4.4 trillion gross issuances in the bond market in 14-15, which has now become nearly 10 trillion in 24-25. In 25-26 alone, bonds worth nearly 3 lakh crores have already been issued, adding to the already outstanding 42 trillion of corporate bonds spread across 656 issuers. The total bond market, government plus corporate, amounts to roughly 226 trillion rupees, about 70% of the GDP. So if one were to look at it, obviously GSECs far outweigh that of the corporate bond, but that's, I think, the case in every single jurisdiction. What does pension funds and PFRDA really come into this? So while public expenditure remains indispensable, the government alone cannot underwrite the vast financing required for India's development. Pension funds have emerged as a vital actor in this landscape, along with the insurance funds. Pension funds hold about 3.5 trillion in corporate debt as on date. Now, what we're really saying is that out of this about 3.5 trillion, something like 70%, 2.5 trillion, is into long-term sectors like energy, transport, water, and social infrastructure. 9 out of 10 pension funds allocate more than half of their corporate bond portfolios to such long gestation projects, reflecting the natural alignment of retirement savings with infrastructure financing. Yet the potential seems vastly untapped. Pension assets in India amount to only 17% of GDP, in contrast to an OECD average of over 80%. The imperative is therefore threefold: expand pension coverage, and that is really what we are tasked to do, deepen household retirement savings, and channelize these resources into the corporate bonds to underpin capital formation and market stability. Alluding to some of the regulatory initiatives and let me say the vehicles that are available to drive forward the bond market, we have initiatives like the reduction of the minimum face value of privately placed debts from 1 lakh to 10,000 rupees, the mandatory use of the electronic book platform. And I think I was really, glad to hear from fellow speakers that we have nearly 40 such platforms available today. The digital market, the digital market infrastructure, which is the online bond platform providers, are now probably settling at T+1. Now, Ananth did mention that is there something we can do to improve that. I think that would be just great, but that's something which we'll wait for the market regulator to look at that. To boost liquidity, NSE's RFQ platform launched in 2020, now with 700 plus participants, is widening the market access. The number of issuers, the limiting issuers to a maximum of 12 ISINs per year, SEBI has encouraged consolidation and liquidity in the secondary markets. We have, on the green and ESG bonds, SEBI launched a comprehensive framework to regulate social sustainability and sustainability-linked bonds, aiming to avoid purpose washing and ensure accountability. The Corporate Debt Market Development Fund marks a turning point and acts as a permanent backstop, stepping in to buy investment-grade bonds from mutual funds during stress, preventing disorderly fire sales. This is something which I was actively involved in while at SEBI, because it was the NCGTC that was creating the backstop facility. And now my only request to the capital market regulator would be to allow for more than mutual funds to get into this, because all long-only funds would certainly benefit a lot from this. The RBI scrapped short-term investment caps, which previously limited FPIs to 30% of their investment in less than 1 year corporate bonds. The concentration limits for both general FPIs and long-term FPIs was also scrapped. These moves are intended to attract more foreign capital and enhance market liquidity. The partial credit enhancements for bonds rated below BBB-, capped at 50% of the issue size, was something that we witnessed the launch of yesterday, with NAPFID coming out with its form of partial credit enhancement. This is something which I personally feel will do a lot to infuse that additional assurance to the pension funds and insurance funds. And I'm sure their interest in the different rated bonds would certainly increase. So as far as the pension funds are concerned, we have allowed them to have an exposure of bonds which are greater than a rating of A. And I'm sure with this credit enhancement facility, we should certainly look at a deepening of the exposure. Let us not forget that we learn from crisis. So we've had the ILFS crisis in 2018. We've had the Franklin Templeton episode of 2020. And both of which have certainly led regulators to review the rules, the guidelines, the processes. And I think that's a constant to and fro that happens between the market and the regulators. But yet we've seen only improvements and more initiatives that have come out in order to increase the depth of the markets. Some of the challenges that still remain, and let me just quickly run through some of them. We have, of course, average trading volumes which are not very large, but I'm sure it will improve with the number of electronic platforms that are now here to stay. Over 97% of issuances fall within AA and above, leaving a very, very small, higher risk category of bonds. The share of public issuances is declining from 12% in 2014 to just 2% in 2024. I'm sure the CRISIL report must be saying something about it, but is that something that we should be concerned for, and what are the ameliorative, vehicles or thoughts around that? We need to probably understand that why is it difficult, or why is it that the rules are making it difficult for greater number of public issuances? The CPSUs and public sector banks dominate, accounting for somewhere in the region of 45% of issuances between FY21 to FY25. We have institutional constraints, so the insurance and pension funds and their regulatory frameworks also may be seen as constraints towards deepening of exposure in the debt market. Challenges to recoveries, one of the speakers spoke about it. I think that's again a very critical point, that the more the market views easy exit, it will cause much more easy entry and more voluntary entry into that market. The credit risk tools like the credit default swaps, they exist in regulation. I'm sure there is a certain amount of activity too in it, but it's really not developed to the extent that we would like it to be. These are the natural hedging tools for funds when they come into this kind of a market. Again, the concentration risks persist, with majority of issuances still dominated by financial sector entities, while manufacturing and mid-sized corporates remain underrepresented. Again, a strange but very persistent phenomenon in the Indian landscape. When we compare ourselves with the global practices, in the United States, the Federal Reserve came in during, of course, a pandemic situation and purchased investment grade and high yield bonds, ensuring liquidity. We have ourselves, I think, come out with an equivalent under the CDMDF. Countries like South Korea and Brazil have deepened their bond markets by actively encouraging participation from pension funds and insurance. And I can assure this audience that, at least from the pension fund side, we are certainly working very actively towards improving and sustaining the growth of the corporates of India. Of course, we have in Europe a high disclosure standard and sustainable finance taxonomies that have set benchmarks for ESG bonds, and India is also trying to align itself with it, with the best interest of the Indian corporates to continue to grow. A quick word on what do we need to do going ahead. One, easily said than done, build liquidity, develop market-making mechanisms, promote repo in corporate bonds, and expand the role of the clearing corporations. Encourage retail investors through fintech platforms. Wonderful to hear that's already happening. While pension and insurance funds are nudged more to allocate to corporate debt. Enhance credit depth by exploring the blended finance models and to build a much more functional CDS market. Use the bond market as a driver of India's climate commitments by scaling up green bonds, transition bonds, and sustainability-linked instruments under credible frameworks. And finally, to strengthen the market infrastructure by standardization of documentation, improved disclosures, and to ensure interoperability between government and corporate bond markets. So, ladies and gentlemen, I think we've all put our, sort of very firm intentions on the table. We would certainly like to work together. We have regulatory fora in which we all come together and we discuss these issues, but I think it's very important that we have these kind of conferences where we can talk to each other in a more informal setting, exchange ideas, and I'm sure with the combined intent of all of us, we'll certainly have a much more vibrant corporate market and lower cost of capital for our corporates to be able to grow and play their part in the development of the country. Thank you so much.
Ramann sir, thank you so much for being here, giving us your time. Ladies and gentlemen, can we have a huge round of applause for him once again? And now for the concluding remarks, I would like to invite the Assistant Secretary General from ASSOCHAM, Mr. Basudev Mukherjee. So sorry, ladies and gentlemen, post this, please remain seated because we'll start the first panel discussion for the day. There is no break. Thank you.
Good morning. It is my absolute privilege to offer a sincere vote of thanks at the end of the inaugural session of this 8th annual conclave on corporate bond markets with the theme Policy Pathways to Strengthen Market Stability and Depth. First and foremost, we're profoundly thankful to our distinguished dignitaries for honoring this event with their presence and sharing with us their wisdom. On ASSOCHAM's behalf, we would like to express our gratitude to Mr. S. Ramann, Chairperson PFRDA, Mr. Ananth Narayan ji, whole-time member SEBI, Mr. Pradeep Ramakrishnan, ED IFSCA, and our council leadership, Ms. Nipa, Sheth, Ms. Aditi Mittal, and Mr. P.K. Malhotra. We would also like to convey our gratitude to Mr. Bhushan, Kedar, Director of Funds and Fixed Income Research, CRISIL, for his insightful views. And a very special thanks to the entire CRISIL team for making available a well-researched, well-documented, and quite in-depth report that will be used as a reference guide for policymakers, investors, and industry stakeholders in the times to come. Ladies and gentlemen, as we deliberate today, it is important to recognize that India's corporate bond market, though progressing, still has an immense room to grow when compared with more developed financial ecosystem. This gap highlights the significant opportunities that lie ahead of us. A robust and liquid bond market is vital not only to finance India's ambitious green transition and infrastructure requirements, but also to provide long-term stable funding avenues for corporates, thereby reducing heavy dependence on the banking sector. Across the world, mature bond markets have played a pivotal role in strengthening financial resilience, channeling both domestic and global capital efficiently. As India sets its sights on becoming a leading global economy, the development of a deeper corporate bond market will be indispensable in fostering investor confidence, ensuring market stability, and supporting sustainable growth. This conclave is not only a platform of reflection, but also one of forward-looking discussions. We have scheduled a series of stimulating panel discussions during the day. These meetings vow to gather the very best brains from finance and policy, and we eagerly anticipate intensive deliberations that will set the stage for sustainable development and stability in this important slice of our capital markets. Lastly, we would also like to express our sincerest appreciation to our partners and sponsors, our illustrious delegates and industry members, media, and our tireless ASSOCHAM team, whose hard work has made this conclave a reality. With that, I would like to ask everyone to join me in extending a grand round of applause to all our illustrious dignitaries, speakers, sponsors, and knowledge partners who have made today worthwhile. Thank you.
Thank you. Thank you so much, Mr. Mukherjee. Ladies and gentlemen, that is our inaugural panel. Can we have a huge round of applause for all of them? I request everyone to please pose for a picture together. Thank you to all our esteemed guests for being here on this panel. Your presence Means a lot to us. Thank you so much.